session. Allow me to welcome on stage Mr. Kevin Goh, Chief Executive Officer at the Ascott Limited. Welcome, Kevin. All right, so as a quick introduction to our topic, mastering growth with an asset-light strategy, in general minds of everybody not here, a crowd of experts, but a hotel brand owns, operates, and have its flag on the building. However, we know that this has drastically changed over the years, and it's not always the case. The asset-light strategy, which helps to scale without heavy capital investment, you minimize the physical ownership of the asset, but then you focus on other core competencies, and I'm sure, Kevin, you shed more light on this. So without any further ado, let's jump into the first question, the one that everybody wants to hear is, how many hotels do you actually currently own, and what is the mix between franchise and managed hotel?
Thanks for that question. Well, we currently operate about 1,000 hotels, but we don't own many of them. We have actually shifted from a fairly asset-heavy portfolio to a very asset-light portfolio. Over 90% of our hotels are actually under a franchise or management contract currently. So, I mean, one of the big shifts that we have done over the years is really to move. We used to only manage what we own, but over the years, we find that it is very challenging to scale if you only have to manage what you own, because there is very limited scale. You cannot invest in technology, you cannot invest in loyalty programs. So from the early 2010s, we started to actually look for third-party opportunities. So in 2008, we only have about maybe 120 hotels. Today we have 1,000. So we've grown above 8 times over that period of time.
So you can say you've done it, you catch that train early.
Yeah.
And when we talk about ownership of hotel versus asset light, have you not moved forward from that investing in the hotel and the real estate to the asset light? What would you say about your growth? Where would be your growth today?
Well, the growth momentum is very strong when it's an asset-light business, because you don't have to dig into your own balance sheet to fund every single hotel that you manage. So I think that has served us very well. We've grown 8 times over the last 15 years, and we still see a very good growth momentum. And it's a very virtuous cycle, because the more hotels you have, the more presence you have, the bigger the network, the bigger the loyalty program, more buildings and more owners will come into our space and give us more projects to manage.
And how does that compare market to market? Do you have markets, and maybe let me drop the question, do you decide to own specific asset in certain cities, market, and what is the reason for that?
I think generally we try and go deep in every market. So for instance, if we decide to have hotels in Indonesia, we have about 200 hotels in Indonesia today. And then if we do Australia, New Zealand, we have another 200 there. And we decided to go to China, we have about 220 roundabouts in China. So what we hope to do is to go very deep into the markets that we operate, and we're predominantly in Asia. So we'll stick to a very asset-light strategy. We try not to own any hotels unless there are very strategic reasons to do so.
Okay. And when you're investing, obviously in real estate, we say that this is where you can have core focus on service quality, brand recognition, and loyalty. So how do you balance between having an asset-light strategy, but still ensuring that all the aspects that I mentioned, and that you have this global quality consistency while you're not anymore the owner of the real estate?
Yeah, so there's a big mindset shift for us. Being owner of real estate and being a provider of brands and being a manager of many of the hotels and service apartments is quite different, right? So in the asset-light world, there are really 3 or 4 stakeholders. Number one, the owner of the building. The owner of the building must be able to derive a good return on the asset. Otherwise, you won't have many hotels or service apartments to manage. The franchisee and the franchisor, right? The franchisee and franchisor need to be able to make a living. They need to be able to operate the hotel or service apartment profitably. And then the third one would be our customers. Right? Our customers need to be happy. They want to come and stay with you. So that's why we have 16 brands in our portfolio, and we offer different lifestyles, different brands for every need. So for instance, of the 16 brands, we have our latest brand, the Life brand, which is an experience-led social living. It's all about technology, about communications, about conversations and communities. It's about for the younger people to come together. We have smaller rooms, but we have much larger common areas. We've got a social kitchen, a meeting area, a co-working area. We have lounge, we have a place for people to gather and meet and have drinks. Even in the laundry, right? The laundry becomes a meeting area, a talking piece for a lot of our customers. So we started this brand in 2019 with just the first one in Singapore. And today we have 35 across various cities. We have Frankfurt, the UK, in London, in Manchester, in Paris, Singapore, Thailand, Sydney, Melbourne. So it's a brand that is gaining a lot of traction for us and giving us a lot of opportunities with our customers. And of course, there are other brands that we have. For instance, the collection brands. The Crest collection is more about heritage. The Unlimited collection is more about the locality, the tradition, the culture of a place. So keeping the customers happy, the operator and franchisee profitable, and the owners satisfied with the returns are actually three very important pieces that we balance in order to deliver a successful asset-light strategy.
And are there specific brands where, and I'm sure there has been discussion to say, no, that we're going to retain most of the real estate for that specific brand, or is not the type of discussion that you're having?
No, I think once we decided to go asset-light, we decide that we will not own any real estate. In fact, most of the real estate, if it's owned, would be by third party, or if we own anything, it would be by some of our other subsidiaries, like, we have a REIT that is listed in Singapore that will own all the real estate. But on the asset-light front, we want to be as asset-light as possible.
And so from an owner perspective, the owner takes the risk on the real estate, you bring your expertise. How do this owner understand how they're going to benefit from that? You come in and say, I'm going to bring marketing powerhouse, loyalty powerhouse, distribution powerhouse. Do they really fully understand this?
Yeah, so many owners like us for our heritage, right? Because we are an Asian player, we're based in Singapore. Southeast Asia is our backyard. We know the geography very well. So the branding power in Asia is actually fairly strong for us. Many of our customers follow us because of our brands in Asia. Distribution is important. We started off very much as a service apartment, but then we've gone on to a flex hybrid model. So although we started off as a service apartment, the service apartment product is very flexible. We can take stays as long as 1 year. Our longest customers have stayed with us for 22 years. But we also built most of our buildings with a hotel license in place, or hotel requirements in place, so that we can also take one-night stays. Right? So owners like us for that business model. In bad times, we can flex more to do longer stays so that we have a more stable earning profile. In good times, we flex more to the shorter end so that we can yield the rates much higher. So I think that's one of the key attractive business model for Ascott. And of course, the other things is about technology, about operational efficiency. Our manpower to room ratio is actually fairly low. Like Live, right? The brand that I just mentioned, our experience-led co-living brand, it can go as low as 0.1 staff to 1 room. Right? In a typical business hotel, it could be anything 1 staff to 1 room. We are at 0.1 staff to 1 room. And in this market where it's very difficult to find labor, such a model actually works very well for us.
When you decided to sell the real estate that you had, what was the strategy in terms of prioritization of reinvesting that cash that came in?
Yeah, so a lot of reinvestment actually goes into building capabilities. Right? So we've been upgrading our technology stack, and now everything, I would say 90% of our technology is all on the cloud. We no longer have to have people at the hotel setting up the server room, plugging in the wires. Everything can be actually configured remotely. We invested in people. We invested in a lot more new capabilities in the areas of F&B, in mines, in running resorts. So a lot of those investments are actually bearing fruit for us, because today we're not just a traditional service apartment. We're bringing a product to resorts, to seaside locations, to mountain resorts, even ski resorts even, because the apartment product is actually quite natural for people who are traveling as a family, traveling with friends. They want to be together. They don't want to stay across 10 hotel rooms. They want to be in a 3-bedroom apartment where in the evenings they could come together in the living area, chat, connect, and be able to interact with one another.
So would you say when you go asset light, aggressive asset light, is there a risk of overheating and losing a little bit of control of what's going on with the brand, with the promise? How would you cope with that?
Yeah, so there are two ways to think about it. One is the organic way, and the other one is the M&A. We've done a few mergers and acquisitions since we started. We bought the Quest brand in Australia. That's the 200 service apartments or hotels in Australia, New Zealand. We bought a brand called Oakwood, which started in the US, very strong in Japan, Korea, and we're bringing it to Asia. We bought a hotel platform in Indonesia called Tauzia, which introduced another 6 brands to our portfolio. So having a M&A strategy allows us to scale up very quickly, and we're on the lookout, to buy more platforms, more brands, if such opportunity presents themselves. And of course, on the organic front, some of the properties, it's a bit of a staggered approach, because some of the properties that we sign up takes about 3 years or 4 years to build. So it buys us a bit of time to build up the capability to service these ones. But of course, we also do conversions, and we have those, what we call the in the year for the year conversions, where we leverage on our existing teams to actually start operating those hotels. So we want to grow, but we don't grow for growth's sake. We want to make sure that we can deliver returns to the owners. We want to make sure that our guests are happy, and we want to make sure that we can operate profitably.
So if there's a booming economy, everybody's happy. All stakeholders are happy. Everybody's making their money. During a slowdown, having this asset-light strategy and the investment burden of the real estate on the owner, how can you still support owners with that strategy?
So I bring us back to the pandemic period, right? During COVID, it was a very difficult time. Some of the hotels actually go down to almost 0% occupancy. But because we have been in the long stay business for a very long time, during pandemic, we actually pivoted all the way to do a lot more long stays. So while some of the hotels have gone down to 0% occupancy, we're able to still maintain an occupancy of about 40% across the whole portfolio. And at 40%, we're able to break even in terms of cost, and in some instances, actually have positive cash flow. So I think we come back to the business model being very resilient, and we're able to support owners during such times, and to be able to still deliver a cash flow or be able to break even on the business during extreme distress. The pandemic is actually a period of extreme distress.
Asset-right strategy, would you say that the biggest and most important element for you is human capital to keep growing, and having the talents and having investment in technology, those two elements?
Yep, I think investment in capabilities, in technology, in people is actually very important, because being asset-light, you're not counting on the real estate to earn a living for you. You're actually counting on the people that run the business and to be able to grow the business for us.
Okay, I think we have about a couple of seconds left. Do we have any question from the audience? Maybe about the loyalty card of that gentleman, 22 years. I'll be surprised to see the points. Any question? All right. Well, I think you're off the hook. Thank you. 30 seconds left. Yep. Thank you so much.